Volunteer Firefighters Incentive Plan Trust and Board Meeting, May 12th, 2021. And we'll do roll call. Trustee Niffen.
Here.
Trustee Foster.
Here.
Trustee Hamilton.
Here.
Trustee Miller, Rosenblum, and Soriano aren't here, and Trustee Malzik's here, so we have a quorum. Second item, the resolution. Would anyone want to make a motion to approve this resolution as printed in our packet?
I'll make a motion to approve the resolution as in the packet.
Thank you. Can I get a support or
Second.
Second by Foster. All in favor, say aye.
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 Aye. Okay, no opposed. Passes 4-0. Public comment. Shazia, no public comment, correct?
Yeah, no public comment. Rob, do we have to do a roll call vote on that or no?
It's okay.
Okay.
I'm trying to be expedient. Next item, minutes from our previous meeting last quarter. May I get minutes from the February 10th meeting? Can I get someone to approve those?
I'll move it.
Approve.
Motion
I'll second.
All right, thank you. Motion approved by Foster, second by Niffen. Any comments? We'll do a roll call on this one. Trustee Niffen.
Yay.
Trustee Foster.
Yes.
Trustee Hamilton.
Yes.
And Trustee Malzak, yes. Item passed 4-0. We have some retirement requests. We have two.
I'll move the retirement request as printed in the agenda packet.
Okay.
Second.
Moved by Hamilton, seconded by Niffen. Can I get, or does any discussion? All right. And Anthony's here too.
Thank you for your patience with me. I had to find the new updated link.
No, thank you for your patience with us. We'll do a vote. Hamilton,
Yes.
Niffen,
Yes.
Foster,
Yes.
Rosenblum,
Yes.
Malzak, yes. Item passed 5-0. And I think we're on to regular business. Greystone, Tim, you're on.
Okay. I heard that we wanted to move along fairly quickly today, so we'll try to do that. The first page would be page 14. So the market has really kind of moved along the lines of where we thought it would, which is what the Fed did and what the government did has created, obviously, quite a bit of economic activity. You saw some of the GDP figures that came out. Earnings have been quite good. We've definitely seen a shift in leadership. I'll touch on that in a moment. We think, however, we're probably more toward the mid-cycle area, which is the early cycle is really more low-quality stocks do well. We think in this mid-cycle area, now that the market's valuations have come up, it's going to be about earnings. And those stocks that can provide earnings will continue to do well. Those that cannot will not continue to move ahead. Now, I said I would touch on leadership. This is a different recovery, more growth, potentially more inflation and higher interest rates. So if you look on this first chart, this is style. And you can see to the left is large cap, then there's mid cap in the middle, and then there's small cap to the right. And you'll notice a couple things. Big changes here more recently, those darker blue bars, that's value versus growth. And you can see value for the first time in a while. It started a little bit around the election, but continued to pick up. You can see value doing better than growth. That happens when interest rates rise, when there's expectations of more growth. Stocks that are more expensive and growthier, they don't do as well in that environment. And that was something that we had talked about. And you can also see as you move out, the smaller the companies were, the better they did. And that's another thing. They're more economically sensitive, so we would expect to see value do better than growth as we continue. And you will also probably see smaller stocks do better than large. If you move one page forward, just to further underline this on 15, look at the difference in the sectors. Before it was consumer staples and technology that were leading the way, and you can see they were actually in the first quarter some of the lower performers. What do you see that did really well? The more economically sensitive areas, energy, financial, industrials, material, real estate. And that probably continues as well when you look back historically. That's what we've seen. If you can move to page 23. So on page 23, you've been hearing about this with gas lately, but there are shortages that are starting to pop up. When companies were reporting their first quarter earnings, we heard about them talking about supply shortages, labor shortages, having a tough time to hire workers. In fact, yesterday they came out with a number, 8.1 million job openings. This is the highest we've ever seen that stat. And so what that does is it's going to cause, we think, go back to economics 101. When supply is limited, right, and there's more demand, you can get prices moving up. So we could see some more inflation based upon that. And you see that coming out in that PMI headline index. If you could move to page 27. This goes back to something that we had shown you before. They've kind of flipped the chart a little bit on you here. But that lighter blue line, that's the value versus growth at the end of 95 through 2003. Now, that did have the technology bubble in it. We don't see a technology bubble now, but you can see how it turned and went the other way, and value started to outperform. And we're seeing the same thing. In this cycle, which was so different than the one after 08, the one after 08, low growth, low inflation, low interest rates, that's when growth does very, very well. And then we get a stretched out recovery as well. That lasted like 10 years. We think this one will be shorter, probably run a little hotter. And as you can see, that blue, darker blue line, which is 2016 to present, starting to turn the other way. And we expect to see that continue. One of the ways you can judge it is watch what's happening with interest rates and watch what's happening with the economic indicators. If they're continuing to come in strong as we reopen the economy, you'll continue to see this trend. Now, one area I will touch on before I'll turn it over to Amy to go into performance is international and emerging markets. You'll see later on, we expect them to be better performers in the next 7 years. That started to happen. We started to see the dollar come down. We started to see international and emerging markets do better. What sidelined that, though, is the COVID cases overseas have been worse. And so that kind of set that back. We would expect to see, and you'll see in the rebalance that we did for you, we would expect to see that's undervalued right now and probably continues as we get through COVID, even in the overseas markets, to see money going that way. That's what we've typically gotten in the type of recoveries we foresee, is that international and emerging markets do better than domestic as well. So once again, those themes of changes in leadership in the market. Amy, if you're there, can you start to pick up on performance? I think that starts on page 43.
I am here.
Okay, great. I didn't see you on the screen.
I know it's hard to see everybody when they're kind of spread out singular at the bottom. So yeah, we'll talk a little bit about performance, give you an update as well. And, look, as you'll see on this page, that the returns just continue to be positive for this portfolio. And that has everything to do with the weighting and the allocation. So we've said for a long time, even during the recession last year, we need to remain overweight to equities. And so you'll see here for that quarter to date return up about 3.5%. That brings your year to date through the end of March. Now, a lot's happened since March, but we'll go through the March numbers and then bring you forward. So year to date, obviously that gives you a 3.5% return the last 12 months. So if you look at this right here kind of tells you what's staying the course and really paying attention to the data points and not necessarily how we were feeling. But this is pretty close to the bottom of last year. The bottom that we saw was a few days before the end of March. But that return, about 37% return by staying with the allocation, being in the portfolio for the long run, and just kind of understanding that we thought this was a V-shaped recovery and the portfolio was rewarded for that. And then you'll see the trailing returns. You'll see the market value that we ended March 31st. We started the year 13,070,000. We ended the first quarter at 13,533,000. So that's where we get that 3.5% return. If you went back to, I won't ask you to go back there, but if you went back to what did a diversified portfolio do, and that's right on top of it. So this portfolio acting exactly how we would expect given the market conditions. Flip down one more page, and let's talk about this allocation. So the red part of this graph, 76% of the portfolio is allocated to both U.S. equities at 52%. We've got international, so developed international at 18%. And then we have another 6% in emerging markets. So we have this portfolio certainly geared to overweight equities. And as we talked a little bit more about this asset allocation study, has everything to do with opportunity set. With the bond part of the portfolio generating, 1 or 2%, makes it very difficult to achieve those types of total return numbers that we have as a target without having this overweight to equities. And we'll talk about some of the changes in the portfolio and some of the views that we might have going forward with that asset allocation study. Fixed income is at basically right on top of 20%. We've fallen a little bit short with the run in equities, and you will see that there is a rebalance that we have on the table. And then we have about 1.5% that is in real estate. And we'll talk about that asset class too. So that's the allocation. You can skip the next page because it's the exact same information. It's also the allocation. And then we'll just talk about the performance of some of these underlying investments. So at the top of the page, you'll see that it says consulting group advisor. And basically what we have in this portfolio is a combination of the emerging markets, the international, and then that total stock market. So as a whole, kind of think global equities in this portfolio, up about 3% for that first quarter. Below that, you'll see that large cap value space. And again, what Tim was talking about, you'll see 8 and 9% here. We're gonna have a chat about Delaware a little bit more. It is an equal weight portfolio. So when you saw that chart that said what sectors outperformed, you can generate a lot of performance in this active management space if you had a higher allocation to, let's just say, energy, right? It's not been a big allocation of anybody's portfolio, but if you were missing that sector or if you were underweight that sector, that would have hurt you in this quarter. Same thing with industrials, same thing with materials. So we're going to look at that. Below that, you'll see Ball and Gainer, which is a portfolio of high quality stocks that pay a dividend and actually grow their dividend. So the strategy here is we want to own really high quality blue chip companies that are focused on growing their dividend by a good 6%. So everything in this portfolio has a very long track record of paying a dividend, and that works in this environment. And then you'll see Winslow large cap growth, right? So we're used to seeing the types of returns where we've got growth outperforming value by 5 or 10%. Here we have the other direction. So having a positive return through the beginning of March is actually a very good thing for a large cap growth manager because there was such a pullback. But you'll see here in terms of value versus growth in the portfolio, we're definitely in that environment that Tim talked about. Below that, you'll see anything that was in small to mid cap and value certainly was the best performers in portfolios. And that trend continues a little bit more in the mid cap space through April and now May, but that value tilt again outperforming. We've got Delaware, which is international value at 6%. Again, what Tim was talking about, non-US versus US, value versus growth. And then you've got the ClearBridge, which is the international growth. And then below that, you'll see the Western core. And so looking at what happened in that first quarter, maybe one of the most remarkable things was what happened with interest rates. So we saw this really fast progression of rates up through 1.5 towards 1.7% on the 10-year Treasury. When you move that significantly in a few weeks, it will impact the value of your bonds. And so that's one of the things that we spend a lot of time on. The fixed income part of the portfolio isn't as fun and exciting as the equities, but is very, very important. So you can see the challenge here for bonds in a rising rate environment. And that's what we're going to watch for the rest of the year. How do we manage a portfolio that has interest rate sensitivity? Well, we're going to look to have those kind of lower duration, lower interest rate sensitive portfolios. And in this particular case, we do that through the BlackRock Strategic Income Portfolio. So that's going to be our strategy. You'll see that in our rebalance as well. That's the part of the fixed income portfolio that we're going to favor in this environment. And then when you get interest rates that kind of settle back out again, is it 1.8? Is it 2%? That's kind of the range that most of us are looking at for the 10-year sometime by the end of the year. Then you can really start to see the income in a portfolio like Western start to really take over, kind of outperform at that case. When you go through this transition, you're going to want to have that overweight to the strategic income type portfolios that have a lower duration. So that's the overall portfolio through the end of March. I will tell you through the end of May, that return now year to date is at 7.5%. So we had a pretty dramatic move in April and a little bit more in May, to the point where we went from a portfolio at 3.5%. Now we're at 7.5%. The vast majority of that outperformance coming from exactly where we saw it in March. So when I look at this May portfolio, it is still the value. It's the Delawares, it's Fall and Gainer, it's the small and mid cap value, and it's the international value, all now well into double digits year to date, somewhere between, call it 11% and almost 21% for those four options. So we think that plays.
Amy,
yeah.
If I could just make a comment, I think what we've started to see too in the portfolio, you can see the performance continues to be quite strong, but what we're seeing is not only the change over, as we mentioned, in leadership, so value versus growth, smaller versus large, international, actually more recently starting to pick up, but we also are seeing this movement in the market that or investors are starting to realize we are not in that early stage of this recovery anymore. We're kind of in that mid stage. And so they are moving more toward quality stocks. And that is definitely in favor of many of your managers, where they're going to own companies that make sense and fundamentally are good stocks, right? That can generate earnings. That's not really what happens when you first come out of a market that was down 34%. At that stage, many investors go toward what's been beaten up the most and sometimes is not very good quality. So it's another thing I wanted to bring out that we've been seeing with many of your managers, is that has been helpful to them as well. Sorry, Amy.
No, that's perfect. Why don't we you want to pull up that kind of rebalance and take a look at, in terms of market value, where we are, and just kind of a segue from what we just talked about with the individual investments. So you'll see down there, we kind of update through the beginning of May. The portfolio down at the bottom is now over 14 million. It's kind of creeping up, 14,066,000 if we go through yesterday. So we continue to have this progress. Certainly May has been a little bit slower after we saw these great returns through April. But in this portfolio, you'll see a little bit of what we talked about reflected in the actual rebalance. So the idea that we would trim from large cap growth, a little bit from the Delaware portfolio and large cap value, the total stock market index, and rotate into a little bit more international, kind of evenly spread out, adding to, because of that lower boundary. So that fixed income line, you can see we have a minimum range there of 20%. And because the equity portfolio keeps running and outperforming, we have this lower limit that we've crossed on the fixed income. So $100,000 being added to the BlackRock portfolio to make sure we're in compliance. And then you'll see an addition here too, as well, to the Vanguard Real Estate Index. So diversification into some of these real assets that we think do particularly well in a rising inflation environment. So that's the thought process. You can see it laid out here in terms of actual dollars. We would be taking $500,000 out of US equities total, repositioning $220,000 to international, $100,000 to fixed income, and $180,000 to the real estate.
Any questions on that rebalance piece?
Yeah.
Tim, are you asking us to put a motion on the table to approve this now?
We would be. The only caveat to that, Rob, that I would mention is when we go ahead and do the asset allocation study and I show you some of the capital markets index, we kept fixed income intentionally low because, after we do that, you may see our expected rates of return for fixed income are very low going forward. And so we may be, talking about changing the target and the ranges again on fixed income. But to get compliant right now, we knew we had to add at least a little bit because even though you change the lower border to 20%, it's with stocks performing so well, as Amy had said, we'd fallen out of that. So yeah, the other moves are more strategic or tactical. That move is really kind of driven by the IPS that we're currently, working with.
Okay. Does anyone have any questions for Tim or Amy at this point? Is there anything we want to discuss before we look to make this rebalance? Hi, Al, by the way, we see you're on now. Anything from anybody?
My only question is kind of not relevant to this, but we don't have to take any money out of this plan, right? Because the 1.7, 1.8 million we're putting in every year, that kind of covers the payments we have to make or something.
Right. This plan actually gets money in every year. So we the city put in 1.8 million, and then there's expenses of I think a little bit over $1 million. So it's net like $300,000 to $400,000, David. Yeah.
Got it. Okay. Cool.
Yeah. Okay. Can I get I actually have one question, Tim, for you before we move on. I haven't heard a lot about inflation until probably maybe just this week. And in our little world here in this city, we're seeing all kinds of inflation. When we go to put out bids now, every bid is substantially over what we had projected from our engineers or whoever. So we've had to go back to council and get several budget amendments in the last few months here. So in our little world, we're seeing all kinds of inflation. Why is it that the talking heads or the experts continue to say inflation will be low until this past week? I finally heard a little talk opposite of that.
Yeah. So the Fed has called inflation transitory. And what they mean by that is that they said, yeah, as we reopen this economy and things get back to normal or maybe stronger than normal because, we weren't as in bad a shape when we shut things down as we maybe were back in 2008. They're thinking, yeah, you'll see some inflationary pressure, but then that should not last that long or continue to move along. I think we showed you this before, there's that money supply chart that we've shown you before, which is basically all the fiscal aid that the government has done, everything that the Fed has done creates a lot of extra money supply. And consumers, if you remember too, we showed you another chart that said consumer spending, even though we haven't fully reopened the economy, has gone not only back to where it was before the pandemic, but has actually gone above it. So I agree with you, Rob. We're starting to hear about gas shortages. That may be only temporary, but we were looking for a rental car the other day to help bring my kid home from college, and my wife can't find one, right? And if you try to find a lot of rental properties or the price of lumber, there definitely seem to be some signs that we've got inflationary pressures. So we've been on the side of it that has said we do expect that because this is a different kind of recovery. You need to position your portfolio that way. And so some of the moves that we're taking here are actually to do that. The one that would be counter to that, Rob, quite honestly, is the movement to put anything in fixed income. Now, we are putting it into an area in fixed income that Amy touched on before with the BlackRock portfolio that still can do well even in an inflationary environment. But, fixed income doesn't do well if there's inflation. There's no doubt about that. And you're going to see, we think more of those areas that are economically sensitive that can still do well in that environment. So we're in that camp that says we're not so sure how transitory it is. We think we may actually see a little bit more inflation. And that, remember how hard it was for the Fed to get to 2% inflation in the last recovery. We don't think that's going to be the case. Now, do we think it's going to skyrocket up? No, we don't think that either. But it's definitely something that we have to keep a watch on because we've seen that those pressures starting to creep up a bit.
Okay. All right. Would anyone like to make a motion on this rebalance?
I'd like to make a motion to rebalance.
Okay. Motion by
I'll second.
Soriano. Who is the support from? Niffin? Okay. Any other discussion?
Hey, Rob, real quick, I've just got one quick question. I may have missed it, but hey, Tim and Amy, do you guys feel that your view with respect to inflation will go through the end of the year into the first quarter, or is it something that you're like, what's your thought on that?
Yeah. Inflationary pressures as we see them probably continue through this year and into next year. Now, beyond that, we'll have to see how the economy is reopening. Are there things that could be stumbling blocks and could slow that down a bit? Yes. But I don't think it just stops this year. We would say this year and into the first half probably of next year. And then beyond that, we haven't really made much of a call. Amy, anything to add?
Yeah, I think just to kind of highlight, we talk a lot about the great part of this environment is reopen and the strength. And I think one of the only risks that we really pay attention to would be if inflation comes in fast and goes a little bit farther, that puts pressure on the Fed. The Fed has to start raising interest rates before they've told us that they're going to, right? They gave us a really long runway. That's one of those short-term probably shocks, both to maybe equities and bonds that we are looking at. And that should feed into the conversation we have about the asset allocation study. If we're worried, we think that the equities, this is a new bull market, right? There's no doubt about that. But second year in has challenges, right? It's not all easy. The low-hanging fruit, we've already been through that. Now we've got inflation. We've got a Fed that doesn't want to raise rates, but if they're forced to do it a little early, what happens to valuations in the equity market? They're all interrelated. So if that's one of our fears, how do we position a portfolio that is 76% equities? We know we can't go to the bond market. We don't believe we should go there. So we need to start looking at what are some other options outside of that traditional equity market that would help protect if that happens, right?
Mm-hmm. Anything else, Alan?
Oh, that's great. Thanks as always, guys. Appreciate it.
Okay. Yep. All right. So let's vote on this rebalance. Alan?
Support.
Chuck?
Support.
John?
Support.
Anthony?
Yes, support.
David?
Yes.
And Rob, yes. Item passed 6-0. Okay, Tim, so now did you want to move on to your educational part?
Well, we actually have to do the large cap value manager search. Because if you remember at the last meeting, we told you Delaware had some issues with personnel turnover. And I think if I got my page numbers right, that would be on page 95. See if I've got those right. Yep. I'll only make you look at 3 pages here. 4. But this really is at the heart of it, and it gives you a lot of those statistics. So this is the risk-reward analysis. And the manager we're talking about, Amy touched on before, was Delaware large cap value. Value we think is going to be an important space. Delaware had some good long-term numbers. They started to struggle a little bit probably coming into this year because they were a little bit more, let's say, traditional from a value perspective. And in particular, they were overweighting healthcare, and that just wasn't working out quite as well. But then what we saw is a couple years ago, they had a retirement of one of their portfolio managers. Then probably a year and a half ago, they had someone leave. And then just again here recently this year, they had a third person leave. Now, our firm still has them on due diligence coverage. We have just looked at that and said, with the underperformance as well as the key personnel leaving on this team, we think it makes sense to look for another manager. So if you look on this page, And I'll really kind of hone in on the one manager in particular. And there's some good managers in here, but one in particular that we like because of their consistency, and that would be Aristotle. And they're kind of the orangey circle that's kind of right above the benchmark. And whether you look at them over 3 years or on the next page 5 years, if you can move one page forward, you see their positioning again, very high rates of return, risk in line with the benchmark. And then if you go to the next page, which would be the 7-year picture, same thing again. And then if you move even one page forward, the 10-year picture, you'd see that as well. And what we've seen from them is even more so than any of the other managers that are on that chart is they've been very, very consistent in what they've done. And as value has come back into favor, they've done well in that environment. And they just seem to have some flexibility within being a value manager. They stay value, that's what they do, but they have some flexibility in terms of sectors and the way that they go about choosing the stocks within their portfolio. So they've had some of the highest rates of return. They've had a very good risk-adjusted rates of return. And then lastly, if you look at them from a fee perspective, they're 28 basis points. So they've got a very, competitive fee structure as well. So, Aristotle would be actually the manager that we like in this space. And we would recommend replacing, your current manager, Delaware, with Aristotle right now.
Okay. Does anyone have any questions for Tim on this at all?
One of the questions I do get about Aristotle sometimes is, what's keeping their people there? They have not had the same problem with turnover of personnel. There's employee ownership. They're a bit of a smaller company. Things like that we think really help to keep people there because that's the talent that creates the track record. So that's another thing I think that I would add that makes us comfortable with Aristotle in the portfolio.
Any thoughts from anyone on the board? Do we want to sell Delaware and move to Aristotle? Any thoughts? Can I get anyone to move?
I will
that?
add one other thing, just if you're wondering. So what would happen is the money that's currently with Delaware would move over to Aristotle. They can sell off what they don't want. They can buy what they do want. That's how that transition will happen. But your costs, right, your trading costs are borne by the contract you have with us. So the movement over from one manager to the other is not going to cost you anything additionally, which is good in making these kind of transitions helpful to the portfolio as well.
Go ahead, Chuck.
That's what I was going to ask, what the cost is going to be. If it's 1-for-1 trade and there's not going to be any cost to it,
Yep.
That mitigates a lot of the issues.
Okay. Would you like to make a motion on that or no?
I'll make the motion to move to Aristotle.
And I'll second it.
Second by Al. All right. Any other further discussion? All right. Let's call the motion then. Chuck. Yes.
Support.
Alan.
Support.
Anthony.
Support.
John.
Yes.
David.
Yes.
Rob. Yes. Item passed 6-0.
Okay. And then, and I know we've taken up a lot of your time, but the annual, and I'm sorry we got it over to you late. You were number one on our list to complete, but our asset allocation studies for 2021 are available. And so what I wanted to do was run through a couple, 2 or 3 pages in there. And what you're going to find out is we're probably going to need to do more of the work that we already had started on. And Amy kind of touched on this as well. So the first page to take a look at would be page 28 of that WSA or asset allocation study. And if you look at this page, for those of you who've not seen this before, these are our capital markets assumptions. And we included our white paper on how we come up with these. So if you ever want to put yourself to sleep at night, pull that out and you can read through it. But it's really got some good information. We don't just throw darts at a board. There's a lot of work that goes into and resources that go into these numbers. But the capital markets assumptions are simply our view on what we expect returns to be and risks to be. And we break it up in two time frames. The first is the strategic over the next 7 years, and then the secular, that's longer term. And I think they're both important. But what we like to do probably is focus a little bit on strategic, because what we may see over the next 7 years, we continue to see expected rates of return coming down. So if you look in the more traditional asset classes, equities in general, just below 6% there on those strategic assumptions and under the annual return count, and U.S. equities right around 5%. And to our point about, what leads the way, whether it's large cap, mid cap, or small cap, what you would see is value does better than growth. That's the cycle that we think we're in, and we're going to need to make sure we're cognizant of that. So, if we need money to go to other parts of the portfolio, we probably pull more from growth, not as much from value, right? And we let value have that leadership in the portfolio. You will also note, when you look at small cap, expected performance in small cap is better than large. That also happens in these kind of recoveries that we see as well. So that's another thing that we'll want to keep in mind. When you move into international, you can see, there are areas of international that have better rates of return than U.S. And in particular, emerging markets has a very strong rate of return relative to U.S. That's in line with the playbook as well. More growth, higher inflation, higher interest rates. That historically has happened as well. So that's something for us to keep in mind.
I have a question.
Go ahead.
So is our
Sure.
assumed growth rate of 6.5% too high then? Or given that long term it'll kind of even out, it's still a fair...
So you're
assumption?
cutting to the chase. That's the pages I'm going to in a second. So I'll pick up some speed, because that's exactly the question that this report, and the work we need to do asset allocation wise has got to answer. So good question, and I'm almost there. The thing that's striking on this, though, to your point of how are we going to get over 6%, look at U.S. fixed income, 1.2%. Now, some of you may have been, there was a MAPERS, I think it was a year or so ago, a gentleman that did a MAPERS one-day seminar, and he actually talked about this, and interest rates had started to come down, and he said the problem for fixed income is as interest rates go up, that doesn't help bond prices. Net, that means, returns in fixed income probably aren't going to be all that healthy, and that's where we have to start looking at that in the portfolio. We like fixed income because it reduces risk, but it also has a big drag on performance, and that's something that we're going to have to, spend more time talking about. You move into the alternatives, we only give you some of them there, but look at the rate of return on Reits, 7% almost. That's why we are adding to that. We've just recently gone to an equal weight on that, and you can see some of the other areas as well that, some of those alternative spaces, private equity, private real estate, MLPs, REITs, they're areas that are, going to garner better rates of return. And, to the question of how are we going to get to 6% or above, especially in the next 7 years, it's adding to those areas. And we need to do it prudently, right? Because we don't want to give up too much liquidity. We don't want to pay too much in fees, but we're going to have to do some things probably differently than we were doing before. And these capital markets assumptions over the next 7 years bear that out. Any questions on any of those? Because where you'll see this impacted is when I go to the next page, because these capital markets assumptions are expected returns and risk all bake into the next pages. So if you can go back to page 4. So on page 4, this is your current mix, the targets in your investment guidelines. Okay, and then if you move over, then you can see these are some other mixes that we've given you to take a look at. Okay, and if you move over to page 5, this is where the rubber meets the road. So look at where it says strategic assumptions and annual rate of return. If we stay the way we are right now, given these new capital markets assumptions, the expected rate of return over the next 7 years is only 5%. Now, the good news is if you look over the next 20 years, look at the rate of return. It is enough to carry the assumption, right? The problem is in the near term, without making any moves, it's going to put a lot of pressure potentially on achieving that rate of return. And if you look at where you are in terms of your targets, right? The overweights and underweights we have are something that we would want to do from a return standpoint, but the risk level or standard deviation has gone up now for the current portfolio. And that's going to make it difficult for the portfolio to be as efficient as possible. As we move out to some of these mixes that take on some more of those, what we'll call our alternative asset classes, what do you start to see? You can see rates of return. So take the last one out there that uses as much as 30% in alternatives. And I'm not saying you would necessarily go to 30%. And even if you do, you're not going to do it tomorrow. But if you did, you can see over the next 7 years, you're much closer to where you need to be. Now, one other thing that I would add to this is these kind of environments where the recoveries are different than the recovery we had after 08 tend to favor active management. The old recovery didn't favor active management as much. So these are what we expect the asset class to do. Active managers try to beat that. And so that 5.7, we could, maybe expect to get some kind of active management premium over and above that, which may get us even closer to the expected rate of return. The good news is, look below, and you can see the 20-year number, right? The longer-term number is still there. So I don't want to throw the 20-year number out the window and not pay attention to it, but I also don't think it's prudent to ignore the fact that some of these returns have come down for some of the asset classes. The other thing you'll note, too, is on that mix to the far right, just as an example, what happens to the risk level? It's at 8.9, much better than where we currently are. So the efficiency of the portfolio is measured through the Sharpe ratio. Look at where that is. That's the most efficient portfolio. How is it getting there? Well, you're getting a better rate of return, but the diversification or lack of correlation between some of those alternatives and the other assets does what? It brings down or keeps down the risk. That's how you drive efficiency through a portfolio. So this I know is a quick snapshot, but what it reinforces for me is prior to this, even when we looked at the 2020 capital markets assumptions, we'd embarked on the idea that we needed to do more education, right, around some of those alternative asset classes and whether or not they needed to be added into the portfolio. We were going to do some of that for this meeting, and I thought it was more important to use this 2021 asset allocation study to re-examine and make sure, are we still on the right track? Why waste our time doing education if, in fact, our current mix is going to get us everything we need and be very efficient? Well, you can see that's not the case. So our recommendation would be to continue based upon these numbers, looking at those other alternative asset classes, looking at where we would take the money from the portfolio, but you will also notice the amount in fixed income, the target does come down in that last mix. So fixed income is a good diversifier, but we know with that 1.2% expected rate of return, it makes it really difficult, right, on expected rates of return. So we have to kind of balance that out a bit in terms of, where our targets and ranges would be on fixed income. So I'll stop there and see if you have any questions on any of those pages that I just reviewed, similar to what you saw from maybe 2020.
Right. So Tim, one of your points was that because last meeting we had gotten an introduction to both private equity and private real estate, and we had talked about going further with some education from managers. So you would suggest that would be at our next meeting then?
Absolutely. Yeah.
Okay.
Good point, Rob, because that's where we were going. And I think if you look at those returns for those asset classes, right, that's where we need to continue to educate ourselves and look at potentially adding those into the portfolio. Yep.
Okay. Does any board member have any thoughts on what we just heard from Tim?
My only concerns are the fees for private equity, the fees for private real estate. And I am concerned because real estate seems to be in a massive bubble itself right now. I mean, talking with our assessor, Nino, at his retirement, he already mentioned that he's been doing assessment for 40 years and hasn't seen this level of real estate price increases. I mean, that's just for Troy. But I worry that is that in an even worse bubble than stocks? Like, I don't know. So I'm a little weary.
I would tell you,
but I'll listen to it.
yeah. No, I would tell you, when you talk residential, there's no doubt, prices there really never softened up. Demand's been huge and prices are high. But commercial real estate, which would be, in the private area or in the Reits like we're rebalancing to, that's where, there's been some concern because of COVID. How is that going to be affected? Are we all going to still be in our houses, or are we going back to our offices? How's that all going to work out? So I think that's a good point, and something that if we do that education, be a great question to ask, a presenter that we would have on that topic.
Okay.
So Tim, when we look at this, it seems like it's some big moves though, right? Like the final one to the right has 13% in private investments. And I do echo David's point about fees. That is always a concern, but I understand sometimes you have to pay a little bit more, but that's a major overhaul to our portfolio.
Correct. Yeah. And what I'm telling you, Rob, to that point is I'm not one of those, consultants that looks at this and says, hey, the numbers don't lie. We need to move there now. To me, that's market timing, right? Particularly when we haven't gotten ourselves educated to a lot of the good things about these asset classes, but maybe some of the other things that we don't like. Where our valuations, what kind of liquidity are we going to have? What are the fees going to be? I want to make sure that we're fully educated on this. And the nice thing is, what did we just tell you? Well, over the last 12 months, ending March, you're up 37%. And, here year to date, you're up 7.5%. So that buys us some time. I don't think there's a need to either market time or rush to make these kind of moves until we're fully educated and feeling comfortable. And we may never get to that last mix, right? But there's definitely some benefit, I think, by doing the education. And I would guess probably adding in some of these asset classes, maybe not to that degree, and not to that degree right away, but as we get down the road, I think this is what you do with asset allocation. It never stands still. You got to stay on top of it. And last year's study and this year's study kind of support the idea that some of the more traditional asset classes are going to be more challenged in terms of returns going forward, and we have to do what we can to help the portfolio through those 7 years.
So there's no action right now, right?
No, the only action I wanted to reinforce today was that we continue, because I know for you it's no fun to probably do a lot of education and have presentations, but I think it's worthwhile. And this report would back that up. And then we'll make decisions about what does make sense in the portfolio and what doesn't based upon that education. So, yeah, the only actionable idea, you summed it up really well, Rob. The next meeting, we'll continue with those two that we identified, private real estate and private equity, and have some managers come in, give us some more education, and then start, maybe making some more decisions about whether they belong in the portfolio or not.
Okay. Sounds good. Does anyone from the board have any other questions or comments for Tim, Amy, or Bob? Okay, good. All right. Well, thank you.
Yeah.
Do you have more on the markets or anything?
No,
Yeah.
I'm sure you're all happy to know that is all we have for today. But the actionable things we're going to move forward on is the transition from Delaware large cap value over to Aristotle, the rebalance of the portfolio, and then we'll make sure we line up for your next meeting some educational presentations on private equity and private real estate.
Okay.
Rob, do we get the actuarial report at the next meeting in August?
We do. Yep.
Okay, that'll be really interesting to see where we're at.
Yeah.
I'm looking forward to that.
Agreed.
Do those come every 1 year or every 2 years with VFib?
The actuary report?
Yeah,
Yeah, so it's every year for VFIP and for the pension, and then
And
for
healthcare
retiree
is 2
healthcare
years.
is 2 years, correct?
which we're getting the healthcare one in August as well. Okay,
Exactly.
that'll be really interesting to see where we're at, because we're overfunded in everything now except this. So, I'm
Well,
looking forward to seeing it.
yeah, retiree healthcare is close, but we've gone from 60% up to probably 95% funded. So we're doing really well in the retiree healthcare. So it's just this one. You're right. That's going to be a sizable contribution.
I just wish we could take 10 million out of the ERS and put it in here to fully fund it, but I know that's not how it works. But I can dream, I guess. But
Right.
yeah, we're like 80 million. I think I ran the numbers based on the last liability from last year, and the ERS is overfunded by like 80 million right now. It's pretty wild. I bet every municipality around here is dreaming of that, but
Yeah,
I
like
would
I
love
said,
that.
it makes our budgeting much easier. When I was in Warren, the first thing I was always in a hole about $45 million before I started budgeting, and here it's only a few million, so it's a beautiful thing. Yeah. All right. Well, thank you everybody for attending today, and thank you for being patient with us as we had to make some last minute changes to the Zoom calls today. So. If no one else has anything, any other comments, we can adjourn. Everyone's good? All right. Take care, everybody. Have a great day.
Thanks, everybody.
Bye, everyone.
Stay well.